Right. Back after a week. It's been a hectic week. So I had to actually take it easy last week, and I couldn't host many of these or any of these rather. Thought I'll start this week quick with an easy introduction. Actually, this one's going to be quite brief. Hopefully, actually less than 10-15 minutes, based on what I want to get through. Um, just as our standard uh, what's it called, man? What's it called when you give people words of warning? I keep forgetting. But anyways, this is not financial advice. It's only my opinions. So I'm trying to get my peers to understand the jargon and the world of finance and how they can begin to make their own educated decisions on their own uh, financial situations or in terms of investing specifically. Nothing to do with their personal finance goals or anything like that. This is only for education purposes, so it's only just try to help you understand what's happening out there, what's available, what you cannot do, more or less. And content is being recorded so that it can be shared on YouTube for access at a later time. If I remember correctly, this is the fourth of my 8 episodes. We're still on track for having eight. I've got ideas for number nine, but we're going to keep that under wraps for now. Um, right. So just to recap what we did last week, we spoke about the jargon of the stock market and why people tend to invest in stocks, and particularly why they would pick or how they would pick stocks. So, just skipping over all of this, I'm just going to skip to the company specific metrics, which is your revenue, your earnings per share, your price per earnings ratio, and other metrics that people talk about when they try to analyze a specific company to invest in. Just to give an idea of what that really looks like, I went on Yahoo Finance and I pulled up some details on Apple. So you've got your market cap, which we spoke about 2 trillion, as we spoke last week. Um, you've got your PE ratio, but the phrase TTM, I don't know what it stands for, but I know what it means, which is it's trailing years data, not the forward looking PE ratio. So you get two ways of looking at it. Apple itself would probably have an entire department of finance, trying to forecast what their future sales or predictions will be, or how many Macs they're hoping to sell, how many iPhones, iPads, and all that stuff. And based on that, they would give the market an estimate based on their filings or their documentation or their investor presentations. So you can look at the price of the Apple stock right now compared to its future expected earnings, and that's one way of looking at PE ratio. But when you add the phrase TTM, it typically indicates this is for the past 1 year rather than the future 1 year, so to speak. And the same for earnings per share, EPS. Earnings per share is basically they're earning about $3 per share that's issued. Just to break down what it is, you've got your date when they issue their earnings. As we spoke last week about dividends, so they pay about 82 cents, 82 fractions of a dollar. Uh, that makes sense, which equates to about 0.68% of Apple's current stock price. Obviously, the percentage number will change in real time on a minute, on a day basis, whatever, however frequently you look at your data. But for every change in price, your percentage would change, but the number will not. And ex dividend date, what we spoke of, which is on the 5th of Feb, if you held Apple stock, one share of Apple stock on the 5th of Feb this year, you would then get that 82 cents or the fraction of it because it's done quarterly, as we last spoke. Average volume and volume. So volume is a number of shares traded on a daily basis, in which case this would be Friday because we're talking about this on a Sunday. So this would be data from last Friday, which would have been the 26th of March. The average volume, Apple trades about 110 million shares per day. So 110 million shares or 111 million shares roughly exchange hands every single day on the stock market with regards to Apple specifically. You've got your bid ask spread. That's two pennies wide as of close. Of course, this would change in real time as as the market changes. And the number here is the number of participants. So 1,100 people or participants are willing to, pay that price to buy one share of Apple, and 1,100 people are willing to sell one share of Apple at that price. Now, it could be that the 1100 is like a glitch or a maximum number for Yahoo Finance. In reality, it could be several hundred thousands in real time. But this is just an example. You will see a number like this. So it's the price multiplied by the number of participants who are interested or who have some sort of buy or a sell order already in place. That makes sense. These are the most basic metrics you can apply. You can apply to a standard stock. You've got, you can look at the financials if you want to. Again, TTM is past, or looking at the previous 1 year, so to speak. You got your revenue, cost of revenue, profits, what the expenses are, and other financials. How much income, EPS, diluted EPS. EBITDA is one of the other famous ones. I don't know what it stands for. I don't really care because I don't trade stocks. But if you want, feel free to Google what it stands for and try to learn or understand what's actually happening out there. Yeah, that's just something for you to get started. Oh wait, there's another, there are more tabs here. So you got cash flow as well. Oh sweet, this is actually very interesting. I've never actually been to this section of Yahoo Finance yet. It's quite interesting. So you can see there's a lot happening out here. All this is public information, by the way. Apple has to issue this data, I think, on a quarterly basis. Oh, this is annual. Okay, this is annualized, but Apple would issue this on a quarterly basis as well. But obviously, Yahoo Finance is doing it on an annual basis. So that's just data you can look at. So the point I'm showing you all of this stuff is because if you really can't be bothered, oh wait, oh there's that graph as well, to see if they actually beat or matched their expected. So the blue circle would be their estimate. Yep. And the actual green circle is the actual data. So earnings, the EPS. Usually, if it does beat EPS, the stock does rally a bit, i.e., it goes up a little tiny bit. It does have an effect. Like investors feel confidence. They're like, oh, okay, Apple's doing great. We must, we feel. I think I can put my money in Apple. So if stocks typically beat their EPS predictions or estimates, the stock does rally on that particular day, or the next day, depending on when earnings come out. So this is quite actually a very interesting data available here. Anyways, so as I said, I don't trade stocks because I think it's not my cup of tea. I deal with other things, but if you really can't be bothered with going through all this information for the 50 companies you want to invest in, because I think for true diversification you should have like 20, 30 different stocks in your portfolio so that they somewhat balance each other out. What we're going to talk about today is actually right down your alley, because that's what is the point of this presentation. And today we're going to talk about, oh, we're going to slideshow from the current slide. So today we're going to talk about market indexes, right? So you always hear about index funds and exchange traded funds. That's next week stuff. So we're going to talk about the funds later on. Today we're going to talk about what indexes are and what purpose they serve out there. So it's basically a portfolio of investments or portfolio of stocks that represent a segment or the entire market. So rather than having 500 stocks in your portfolio, you can just have one index fund that the fund tracks the index, and the index's value is determined by the price of the underlyings it holds, right? So you got various types or various ways of indexing, really. The most common one is your market cap weighted index. So that's basically giving the company a fraction of the index as per their market capitalization compared to the entire market. So if we assume that the entire stock market is roughly $100 trillion worth, in reality it's more like 85, but let's assume for the sake of simple math, and we just saw Apple is worth roughly $2 trillion. If a market weighted index or market cap weighted index decided to include Apple in, they would allocate roughly 2% of their portfolio to Apple, provided they're trying to index the entire market, which is worth 100 trillion. So when you actually invest in an index fund that tries to track this index, or when the in or rather uh, when the index is trying to allocate its resources, or the money or whatever, then about 2% of your $100 would go towards buying a share of Apple, so to speak. So that's what market cap weighted index. It's basically just allocating the portfolio percentage as per the market capitalization of the company. We spoke about market cap last week. I hope you remember that. Based on the market cap weighting of the company, and it depends on how many companies you have, and so on and so forth. So it's not a fixed number, but it's dynamic on the number of companies you have, as well as what the company's respective market caps are. Funnily enough, you also got a revenue weighting, which is basically like market cap, but rather than a market cap as your base factor, you look at the revenue of the company, how much they're bringing in on a quarterly or annual basis, and you rebalance the index accordingly. You've also got float weighting and other fundamental factors that are decided by the index provider or issuer. I think one of the real weird ones, which is quite famous, is the Dow, which is a stock price weighted index. It's really weird, but it was created back in the early 1900s, where this guy in a newspaper company tried to estimate the value of the U.S. stock market. By doing some quick calculations based on the price of the shares. So he used to have a blackboard, and he should issue this price every day in his newspaper column, and that's what has now, by tradition, become the Dow Jones Industrial Average, which is abbreviated to DGIA, or so on and so forth. So that's what a market index is. It's basically a segment or the market, depending on what the index's rules are supposed to be, or determined to be as per the index provider or issuer. I'm just going to say either of those words, but they're interchangeable in my context today. So the idea of the index, obviously, it sets a benchmark for the relevant sector. So you've got for the entire market, you've got the S&P 500. That's the US as top, or the biggest 500 companies. That's often referred to as the market, because it tries to summarize the 500 biggest companies in the US, which is one of the biggest stock markets in the world. uh, but the popularity in recent times of investing has actually led to a index for a wide range of industries. It's not only the entire market, but you've got indexes that try to track battery tech. You've got indexes that try to track electric vehicles, clean energy, biotech, fintech, blockchain innovation, and so on and so forth. So what these indexes do are they try to try to define rules, or try to identify stocks which would align with what they want to achieve. So, for example, electric vehicles. Uh, the index provider in this case would try to make a list of all the companies that are either involved in the manufacture or the supply chain of electric vehicles, and then they will sit and decide how they want to weight the index. They could be market cap weighted, they could be value weighted, or based on any metric that they choose for it to be. So in which case you'd have companies like Tesla, you'd have battery manufacturers from China, you'd have other car manufacturers who are moving towards electric. So don't be surprised if you see Volkswagen or Kia in there, even because they are moving to electric, and the index provider would see or justify their existence within the index itself. And a lot of people would be surprised wherein there already is an index fund. We'll talk about it next week, don't worry about it, that tracks the electric vehicle index. And people complain, I've seen on Reddit, so to speak, that people complain that why is Hyundai, Kia, or Volkswagen in there. But it won't be surprising to see, because these people are making a move towards electric vehicles, so they do belong in such an index. But you've also got biotech and fintech. So one of them that comes to mind is oh, that's actually a very poor example. That's an ETF. Oh, never mind. But you got indexes for all of this. You got indexes that try to track the esports industry. So I was having a chat with one of my colleagues, or my mates, about a few weeks ago, and he's like, I've really been thinking. Well, this is what he said. He's really been thinking about investing in esports, or gaming, or chip manufacture, or semiconductors. And he's like, I think that's a way to go forwards, and that the future is all technological, and these companies are going to go big. And I'm like, rather than buying the 50 companies you just defined to me, AMD, Intel, um, and a bunch of others, Nvidia and stuff like that. I told them, rather than you mentioned 10, 15 companies in your talk just now. other than that, have you just looked at the ESPO or ESPO ETF, which tracks some sort of index that tracks all the companies related to such an industry, so to speak? So, as I mentioned, there most likely is a fund that tracks the index and hence allows the investor to replace their 500 or 50 or 20 stocks with just a single fund in their portfolio. It basically cleans up, and management is just so much easier. That's the upside. The downside is you can't allocate how much ever you want to. So if you think Nvidia will do better than Intel, but the fund provider thinks otherwise and allocates a bigger percentage to Intel, then it's tough luck for you. Then you're going to have to, you can buy the index fund and Nvidia separately so that you have a great exposure to Nvidia, or you just have to play on it yourself and create your own portfolio with the 50 stocks as I mentioned. But the point of the fund is so that you just find one that matches your goals, and then see the constituents of the index. Always do that. Just make sure what the index actually contains, if it suits your investing style or your goals, and then begin to contribute to the index, and basically just set and forget. That's the whole point of these of indexes or index funds. So apart from benchmarking, it's also the funds themselves act as vehicles for you to set and forget, so to speak. So there's some of the popular indexes that many or most of you may have heard of by now. So you've got the FTSE 100, which is the 100 biggest companies in the UK as per their market cap. You got the FTSE 250, which is the 101st to the 350th largest company. So the next 250 after the FTSE 100. The S&P 500, as I said, it's one of the most famous benchmarks, and it just indicates the market, because the US market is like the biggest in the world right now, and so trying to benchmark against the S&P is a good way of seeing how your portfolio is doing if you're an individual investor who doesn't invest in funds, or who goes at it himself, so to speak, an active investor. The Dow Jones again is a 30 large companies as per price. The Nasdaq Composite is all the companies listed on the Nasdaq Stock Exchange, which we spoke about a few weeks ago. But you also got the Nasdaq 100, which is the 100 biggest companies on the Nasdaq Stock Exchange. So you can have multiple various indexes tracking a single tracking on a single stock exchange, or tracking a single objective, so to speak. So you're not limited to these. Don't limit yourself to what you see on the screen. There are like hundreds of indexes out there, and thousands of index funds that track these indexes. And then you've got the Nikkei, which basically tracks the Tokyo Stock Exchange, or it's a good estimate of how the Tokyo Stock Exchange is doing. So yeah, that's the popular index that we go forward to. So that's basically it. And I think I don't know who actually did that. I think it was either Peter Lynch or Warren Buffett. So if you don't have time to analyze the business, as I said in the beginning of this conversation, then just buy an index fund, and don't worry about buying individual stocks or doing your own research. I think index funds are one of the easiest and safest ways to invest. Of course, investing has its own risks, but you cannot minimize risks any further than with an appropriate index fund. So don't freak out if you don't know what an index fund is yet. We're going to discuss that next week, because, as I mentioned, there are funds that track indexes. So today I just wanted to get across the point of what indexes are and what their purpose is. And as usual, my references are also available on the slides when I upload them with this video on my YouTube. Yeah, feel free to access them, have a read. Most of them are extremely helpful, and they will teach you a lot more than what I've just spoken about. But you can obviously get started there. So the reason I wanted to be back to back, which is today and tomorrow, so that we can talk about indexes today and then index funds tomorrow, so that it's fresh in the back of your mind. Cool. So yeah, if you've got any questions, then by all means put them in chat, or feel free to unmute yourselves. But I think apart from that, this has I think that's all I wanted to put across for today, which has been excellent. But yeah, thank you for your time, guys. I'll see you again tomorrow.